Imagine you're standing at the edge of a swimming pool in the middle of a hot Florida July, and you've got two choices. You can either dive in head first and get the shock over with, or you can slowly, painfully inch your way down the ladder, letting the cold water hit your ankles, then your knees, then your ego. Most of us treat our investment capital exactly like that cold pool water, especially when we're staring at a chunk of cash in a high-yield savings account that we've spent years grinding to save up. You've got $50,000, or maybe $100,000 from a house sale or a lucky bonus, and the conventional wisdom tells you to be careful and don't put it all in at once because the market feels top-heavy. But what if I told you that being careful is actually the most expensive mistake you could possibly make? What if the very strategy designed to protect your feelings is actually lighting your future retirement on fire? Today we're going to strip away the emotional fluff and look at the cold, hard math behind lump sum investing versus dollar cost averaging, and why the way you choose to enter the market today will dictate whether you're retiring on a beach in South Carolina or working a greeter job at age 75. Let's start with the elephant in the room, the fear of the top. Everyone thinks they have the worst luck in the world, and that the second they hit that buy button, the S&P 500 will plummet 20%. It's a valid fear, sure, but it's not grounded in reality. If we look at the historical data provided by Vanguard, they analyzed decades of market performance and found that lump sum investing, putting all your money to work the moment you have it, beats dollar cost averaging 68% of the time. Why does this happen? Because the U.S. stock market is fundamentally biased toward growth. In 41 out of the last 50 years, the market ended the year higher than it started. When you choose to wait or to drip feed your money over 12 months, you're essentially betting against the most successful economic engine in human history, hoping for a disaster just so you can feel a little bit better about your entry price. Think about it this way. If you had a machine that paid you $10 every day it was turned on, would you wait 6 months to plug it in just because you were afraid the power might flicker? Of course not. The stock market is that machine, and every day your cash sits on the sidelines in a low-interest account, or even a high-yield one, you're missing out on the compounding effect that builds real generational wealth. But I get it, you're human. You've got a mortgage, maybe a couple of kids who need braces, and the idea of seeing your hard-earned $100,000 turn into $80,000 overnight is enough to make you lose sleep. This is where dollar cost averaging, or DCA, comes in as what I like to call emotional insurance. It's not the mathematically optimal move, but it's the move that keeps you from panicking and selling everything at the bottom. If you decide to spread that $100,000 out over 6 or 12 months, you're paying a regret tax. You're accepting a likely lower return in exchange for the peace of mind that if the market crashes next week, you'll only have a fraction of your capital at risk. But here's the thing. Most people use DCA as an excuse for procrastination rather than a calculated strategy. They say they're going to invest $10,000 a month, but then the market hits a new all-time high, and they say, I'll just wait for a dip. Then the dip never comes, or it comes and they're too scared to buy because the news is screaming about a recession, and suddenly 2 years have passed, and that cash has lost 10% of its purchasing power to inflation. The cost of procrastination is the silent killer of American retirement dreams. We focus so much on whether the S&P 500 is at 5,000 or 4,800, but we ignore the fact that the biggest factor in your final balance isn't the price you paid, it's the time you spent in the game. Let's talk about where you're actually putting the money, because the what is just as important as the how. Most people in their 30s and 40s default to an S&P 500 fund like VOO, and honestly, you could do a lot worse. The S&P 500 is the gold standard, the top 500 companies in the U.S., dominated by the tech giants we all know: Apple, Microsoft, Amazon, Nvidia. It's a powerhouse, but it's also becoming increasingly concentrated. If you want a truly set-it-and-forget-it portfolio that doesn't require you to check CNBC every time Elon Musk tweets, you should be looking at VTI, the Vanguard Total Stock Market ETF. While VOO gives you the 500 biggest players, VTI gives you everything, over 3,500 companies, including the small and mid-cap stocks that might become the next giants of the 2040s. VTI offers a layer of protection that the S&P 500 doesn't. If the tech sector faces a massive valuation correction, which, let's be real, has happened before, VTI's broader exposure helps cushion the blow because you own the rest of the American economy too. You're buying the dry cleaners in Ohio, the biotech startup in Boston, and the manufacturing plant in South Carolina, not just the software companies in Silicon Valley. Now, let's talk about the drag. In the investing world, there are people whose entire job is to convince you that they are smarter than the market, and they'll gladly charge you a 1% fee to prove it. 1% sounds small, right? It's just 1 penny for every dollar. But over a 30-year career, that 1% fee can eat up to a third of your total wealth because of the way it stunts compounding. If you use a low-cost fund like VTI or VOO, your expense ratio is 0.03%. That means for every $10,000 you invest, you pay Vanguard $3 a year. $3. That's the price of a cheap burger once a year to have some of the brightest minds in finance manage your assets. The real secret to that multi-million-dollar retirement isn't finding the next Nvidia or timing the bottom of a recession, it's the boring, unsexy habit of automation. Think about all the money that leaks out of your pocket every month. The Uber Eats orders because you were too tired to cook, the subscription services you haven't watched in 6 months, the random Amazon purchases at midnight. If you took just $300 a month, less than the cost of a couple of nice dinners out, and automated that into a brokerage account or an IRA, the math is staggering. Over 30 years, at a 10% average annual return, that dinner money turns into over $600,000. And that's if you never increase the amount as your salary grows. If you're in your 40s and starting late, you have to be more aggressive, but the principle is the same. You aren't saving for retirement, you are buying your future freedom. Every share of VTI you buy is a tiny employee that works for you 24 hours a day, 7 days a week, 365 days a year without ever asking for a raise or a vacation. So, what's the move? If you're sitting on cash right now, the data is clear. The most profitable move is to grit your teeth and put it in today. Dive into the pool. But if your stomach is doing somersaults and you know you'll sell the moment the market drops 5%, then set up an automated plan to get it all in over the next 3 to 6 months. Just don't let it sit in cash forever. Cash isn't a safe haven. It's a melting ice cube in a world of 3 to 4% inflation. Every year you wait, that ice cube gets smaller, and your future lifestyle gets a little more modest. We've seen the 4% rule in action. The idea that if you have 25 times your annual expenses invested, you are effectively financially independent. But you'll never get to that magic number if you're always waiting for the perfect time to start. The perfect time was 10 years ago. The second best time is right now, while you're still earning, still breathing, and still have the power of compounding on your side. You have to decide if you want to be the person who played it safe and stayed comfortable but broke, or the person who took the calculated risk of trusting the American economy to do what it has done for a century. Are you going to keep waiting for a better entry point while the world passes you by? Or are you finally ready to stop being a spectator in your own financial life?